Imagine waking up one morning, walking to your neighborhood bank, only to discover that overnight it no longer belonged to its owners. It now belonged to the government of India. No warning, no debate, no parliament discussion. Just one ordinance signed in the dead of night. On 19th of July 1969, Prime Minister Indira Gandhi nationalized 14 of India's largest commercial banks. Her supporters celebrated it as a victory of socialism over capitalism. Critics even said that it is the biggest expansion of government control over India's economy. But more than 5 decades later, this single decision continues to divide economists. Did it empower the poor, or did it quietly lay the foundation for India's biggest banking crisis? Could one political decision in the year 1969 be connected to the massive NPAs, taxpayer funded bank bailouts, and financial stress that India witnessed decades later? So, this story is not just about the story of banks, it is the story of how politics entered into India's financial system and how its consequences are still being debated today. Namaste, I am Sonam Singh, and in this video, let's travel back to 1969. India had been independent for just over 20 years. The economy was still fragile. Industries were growing slowly, agriculture remained the backbone of the country, banks existed, but banking was not accessible to everyone. Most branches were located in cities. Farmers were dependent on money lenders. Small businessmen struggled to get loans. Credit largely flowed towards established industries and urban businesses. The government even believed that private banks were serving only a small section of society. This became the justification for one of the biggest economic decisions in India's history. But economics wasn't the only story. Politics was equally important. In 1969, the Congress party was deeply divided. Indira Gandhi was locked in a fierce struggle with senior Congress leaders known as the syndicate. She needed an issue that would place her firmly on the side of the common citizens. Bank nationalization became that particular one. It sent a powerful political message that the government, not industrialists, would now control the national financial resources. To millions of Indians, it sounded revolutionary, and to her political opponents, it was a dangerous concentration of economic power. On the night of 19 July 1969, the government issued the Banking Companies Acquisition and Transfer of Undertakings Ordinance. 14 of India's biggest commercial banks were nationalized overnight. These banks controlled nearly 85% of the country's banking deposits, and in one stroke, the Indian government became the country's biggest banker. It was one of the boldest economic decisions independent India had ever seen. Initially, the results look very impressive. Bank branches expanded rapidly. Villages that had never seen a bank finally received one. Farmers gained institutional credit. Small businesses found new opportunities. Priority sector lending became central to banking policy. For many Indians, nationalization genuinely transformed access to banking. And even today, these achievements remain one of the strongest arguments in favor of the policy. But something else was changing while banks were reaching villages. Politics was entering the banks. Earlier, a bank manager primarily asked just one question: can this borrower repay the loan? And after nationalization, another question gradually became important: does this loan fit government priorities? Banks slowly stopped functioning only as commercial institutions. They increasingly became instruments of government policy. Successive governments realized something powerful. If you could control banks, you could also control the flow of credit, and credit can influence elections. Public sector banks were increasingly expected to support government schemes. Loans were directed towards sectors identified by political leadership. Commercial judgment slowly weakened and the risk management became secondary. And as a result, political priorities became primary. One phrase became famous across India: loan melas. Mass loan distribution programs, thousands of loans sanctioned, minimal scrutiny, little attention to repayment capacity, limited post-disbursement monitoring. The objective was very simple: distribute credit quickly. Whether the money returned often became a secondary concern. Every banking system survives on just one principle: loans must return. Once borrowers begin believing repayment isn't essential, the entire financial system weakens. Government backed lending created another perception that loans could eventually be waived. Successive loan waiver announcements reinforced this belief in many regions. Banks found recovery increasingly difficult. The professional bankers lost autonomy. Administrative instructions increasingly influenced lending decisions. And hence, over time, the discipline that keeps banks financially healthy slowly eroded. This wasn't visible immediately. The effects took decades. But slowly, bad loans began accumulating. Banks continued lending, recoveries remained weak, monitoring remained inadequate, accountability weakened, and eventually the banking system reached a breaking point. India entered the era of massive NPAs. But what exactly is an NPA? Let's understand this simply. Suppose a bank lends rupees 100 crore, the company never repays. That money becomes a non performing asset. It is money that exists on paper but doesn't come back. Now imagine this happening thousands of times across hundreds of companies across decades. The result? Lakhs of crores locked inside unrecovered loans. Banks cannot simply disappear. People's savings are inside them. So, what happens when public sector banks suffer massive losses? Well, the government injects money. And where does that money come from? Taxpayers. This process is called recapitalisation. Instead of building new highways, hospitals, schools, or investing elsewhere, thousands of crores had to be used simply to keep public sector banks financially alive. The damage didn't stop there. As NPAs increased, banks became cautious. Instead of lending, they became afraid to lend. Entrepreneurs found it harder to obtain finance. Industries, well, they struggled. Infra projects slowed. Money that should have generated new businesses remained trapped inside bad loans. A banking crisis became an economic crisis. Eventually, India recognized the need to reform. Loan monitoring became stricter, corporate governance improved, and the Reserve Bank conducted asset quality reviews. The Insolvency and Bankruptcy Code created faster mechanisms to recover loans. Banks strengthened risk management, technology improved transparency. The objective became very clear: never allow political priorities to completely replace commercial judgment again. But was nationalism completely wrong? Not necessarily. History is rarely black and white. Without nationalism, would banking have reached India's villages so quickly? Would millions of farmers have gained institutional credit? Would financial inclusion have expanded at the same pace? These are very important questions. Supporters say that nationalism transformed India's society. Critics even say that it weakened institutionally India. Perhaps both arguments contain elements of truth. But more than 56 years have passed since that midnight ordinance. India has obviously changed, the economy has changed, its banking system has changed. Yet the debate continues. Was the expansion of banking worth the loss of institutional autonomy? Could India have achieved financial inclusion without allowing politics to dominate commercial banking? Those questions remain relevant even today because every time taxpayers recapitalize a public sector bank, every time discussions on banking reforms emerge, every time governance and accountability became national issues, the shadow of 19th July quietly returns. History teaches us one thing, that good intentions alone are never enough. Strong institutions matter, professional autonomy matters, and when financial decisions become political decisions, the consequences can last for generations. Thank you for watching. If you found this video informative, don't forget to like, share, and subscribe to Organiser. I'll see you in the next one.